The inverted hammer pattern observed at the bottom of a downtrend signals a potential bullish reversal. This pattern emerges when, during a trading session, prices initially drop, but then buyers push the price up, closing near the session's high. The resulting candlestick has a small body with a long upper shadow and little to no lower shadow, resembling an inverted hammer. This shape suggests that the selling pressure could be waning, and a bullish turnaround might be on the horizon if subsequent trading confirms the uptrend with higher closing prices. Understanding this pattern helps investors anticipate changes in market sentiment, offering an opportunity to enter the market just as it begins to shift upward. Identifying an inverted hammer at the bottom is crucial for traders and investors who follow technical analysis. This pattern appears after a downtrend and can signal a potential bullish reversal, meaning that the current trend might reverse from bearish to bullish. To recognize this pattern, look for a candlestick with a small body at the lower part and a long upper shadow or wick, which should be at least twice the length of the body. This shape resembles an inverted hammer, hence the name. The small body shows that there was little movement from open to close during the period, while the long upper shadow indicates that buyers were able to push the price up significantly, but couldn't maintain those levels until the close. In practice, the appearance of an inverted hammer after a downturn suggests that buyers are beginning to outweigh sellers, potentially leading to a price increase. However, it's important for investors to wait for further confirmation before making any decisions. This confirmation could come in the form of a green candle closing above the inverted hammer, indicating buying pressure. As such, identifying this pattern can be a valuable technique for predicting market direction, particularly in the context of other supportive technical indicators and volume analysis. The inverted hammer at the bottom pattern is considered a bullish reversal indicator that typically appears after a downtrend in the stock market. This pattern gets its name from its shape, which resembles a hammer turned upside down. It features a small body at the lower end of the trading range, with a long upper shadow that is at least twice the length of the body, and little to no lower shadow. This shape indicates that during the trading period, buyers were able to push the prices up, but not enough to secure a strong finish near the high of the day. However, it signals that buyers are beginning to outnumber sellers. Deciphering market sentiment is crucial in understanding why the inverted hammer pattern is significant. Market sentiment refers to the overall attitude of investors toward a particular security or the financial market at large. It represents the psychology of market participants and can be bullish, bearish, or neutral. When an inverted hammer appears after a period of price decline, it suggests a potential shift in sentiment from bearish to bullish. During the period that forms the inverted hammer, although sellers initially control the price driving it lower, buyers step in and push the price back up, showing a fight back against the prevailing downward trend. This wrestle between buyers and sellers highlights uncertainty, but also indicates that buying interest is picking up, suggesting a possible change in sentiment and a potential upward reversal in price. Understanding these patterns and the accompanying change in market sentiment can be valuable for investors and traders. It offers insights into potential turning points in the market, allowing them to make more informed decisions about entry and exit points for trades. However, it is always prudent to use these patterns alongside other indicators and forms of analysis to confirm potential market moves, as no single indicator can provide complete certainty about future market directions. The inverted hammer at bottom pattern is a formation observed in financial charts, indicating a potential bullish reversal when it appears after a downtrend. This pattern is characterized by a small body located at the lower end, with a long upper shadow and little to no lower shadow. The body represents the difference between the opening and closing prices for the period, while the upper shadow shows that prices were pushed upward but retreated to close near the opening, suggesting a struggle between buyers and sellers. The nature of this pattern as a signal for reversal lies in its portrayal of buyers' effort to overcome selling pressure. The presence of a long upper shadow indicates that during the period, buyers were able to push prices higher, although the close was near the open, showing that sellers pulled the price back down. This hints at a decreasing selling pressure and a possible shift in momentum towards buyers, making the inverted hammer a critical pattern for traders and investors to watch. When identified correctly after a sustained downtrend, this pattern suggests that the downtrend may be losing strength and that a reversal to an uptrend could be imminent. Investors and traders might consider this pattern as a signal to carefully evaluate potential entry points for long positions, keeping an eye out for additional confirmation of a market reversal in subsequent trading periods. The identification of this pattern and the understanding of its implications could play a crucial role in decision-making processes in financial markets. Confirming the signal of an inverted hammer at the bottom of a downtrend involves several steps aimed at validating this pattern as a potential indicator of a bullish reversal. An inverted hammer is a candlestick pattern that occurs at the bottom of a downtrend and is characterized by a small body with a long upper shadow and little to no lower shadow. This pattern suggests that the buyers are attempting to push the price up, signaling a potential change in the market sentiment from bearish to bullish. To confirm the signal of an inverted hammer, investors and traders look for additional confirmation in the trading sessions that follow the appearance of this pattern. A common approach is to observe the next candlestick. If the subsequent candlestick closes higher than the close of the inverted hammer, it can be considered a confirmation of the bullish reversal signal. This indicates that buying pressure is increasing, and the downward trend may be weakening or coming to an end. Volume is another critical factor in confirming the signal of an inverted hammer. An increase in trading volume on the day the inverted hammer appears and the days following provides further evidence that buyers are entering the market and could potentially drive the price up. Higher volume suggests stronger interest and commitment to the emerging bullish trend. Furthermore, the context within which the inverted hammer occurs is paramount. This pattern holds more significance when it appears after a sustained downtrend or at a key support level. The history of price movements and the overall market trend should always be considered to assess the potential impact of an inverted hammer accurately. In conclusion, confirming the signal of an inverted hammer at the bottom requires careful examination of subsequent price action, trading volume, and the broader market context. When these elements align, the inverted hammer can serve as a reliable indicator of a forthcoming bullish reversal, guiding investors in making more informed trading decisions. The inverted hammer at the bottom of a trend is a candlestick pattern often seen as a signal for a potential bullish reversal, especially when it appears after a downtrend. This pattern is characterized by a small lower body, little to no lower shadow, and a long upper shadow. The long upper shadow indicates that the buying pressure was greater during the session, attempting to drive the price up, but selling pressure managed to bring the price back down before the close. However, the presence of buying pressure is a key indicator that the downtrend could be losing momentum. When considering the reliability of the signal provided by the inverted hammer at the bottom, it is crucial to understand that no single indicator can guarantee future market movements with absolute certainty. The reliability of this pattern depends on several factors, such as the volume during the time the inverted hammer occurs, as well as subsequent market actions. A higher trading volume can suggest stronger buy-in from investors, enhancing the credibility of the potential reversal. Additionally, it is recommended to look for confirmation in the form of a bullish candlestick or an upward movement in the following sessions. This confirmation helps to validate that buyers have indeed taken control and that the downtrend may be reversing. In summary, while the inverted hammer at the bottom provides an early warning of a potential bullish reversal following a downtrend, investors should seek additional signals and consider the broader market context to assess its reliability. It's also advisable to integrate other forms of analysis, such as fundamental or other technical indicators, to make more informed investment decisions. The inverted hammer at bottom pattern is recognized as a bullish reversal signal in technical analysis, which is particularly meaningful after a market has been in a downtrend. This pattern resembles a hammer turned upside down, with a short body at the bottom and a long upper shadow, indicating that buyers attempted to push the price up during the session. However, sellers managed to bring the price down from its highs by the close, which creates the characteristic long upper shadow. Despite the seller's effort, the appearance of this pattern suggests that buying interest is starting to outweigh selling pressure, hinting at a potential change in direction from a downtrend to an uptrend. When we talk about synergy with other technical analysis tools, it means that the inverted hammer pattern does not operate in isolation. For a more comprehensive analysis, traders often combine this pattern with other indicators and tools, such as moving averages, relative strength index, RSI, and volume analysis. For example, an inverted hammer pattern that occurs near a significant moving average or at an oversold condition on the RSI may provide stronger confirmation of a potential bullish reversal. Similarly, an increase in trading volume on the day the inverted hammer appears can further validate the likelihood of a change in market sentiment from bearish to bullish. Integrating the inverted hammer pattern with other technical analysis tools aids traders in making more informed decisions by providing a more nuanced view of the market. This approach enhances the reliability of predicting future price movements and helps in identifying more robust trading opportunities. The inverted hammer at bottom is recognized as a bullish reversal pattern that typically emerges following a downtrend in the market. This pattern heralds potential upward momentum or a shift in market direction. Visually, it is characterized by a small body situated at the lower end of the trading range, with a long upper wick and little to no lower wick. The long upper wick signifies that buying interest was present during the trading period but faced resistance, suggesting a struggle between buyers and sellers. Navigating the pitfalls associated with this pattern requires careful consideration. First, confirmation is crucial before acting on the pattern. A single pattern does not guarantee a market turnaround, hence, it's advisable to look for additional bullish signals in the following trading sessions, such as a closing price above the inverted hammer. Second, it's important to consider the volume during the formation of the inverted hammer. Higher trading volume can lend credibility to the potential reversal, indicating a stronger buying interest. Moreover, setting appropriate stop-loss limits is pivotal when trading based on this pattern. Given the inherent unpredictability of markets, a predefined exit strategy helps mitigate potential losses if the market does not move as anticipated. In summary, the inverted hammer at bottom can signal an upcoming bullish reversal after a downtrend, but it requires confirmation and a thoughtful approach to manage risks effectively. When observing the inverted hammer pattern at the bottom of a downtrend in financial charts, it signals a potential bullish reversal, indicating that the market may be poised for an upturn. Let us delve into the strategic applications of this observation. The inverted hammer appears during a downtrend and is characterized by a small body at the lower end with a long upper shadow. This pattern suggests that although selling pressure initially pushed the price lower, buyers managed to regain some control by the session's end, pushing the price back up, albeit not enough to secure solid ground, which is why the candle closes near where it opened, leaving a long upper shadow. The strategic significance of this pattern lies in its ability to signal a shift in momentum. Investors can use it as a cue to prepare for potential buying opportunities, considering that the downtrend may be losing steam and a reversal could be on the horizon. However, it is critical to look for confirmation before acting on the pattern. Confirmation could come in the form of a subsequent bullish candle closing above the inverted hammer's close, increased trading volume, or other bullish indicators aligning in the days following the appearance of the inverted hammer. Moreover, incorporating additional analysis tools such as trend lines, moving averages, or momentum indicators can enhance decision-making. For instance, if the inverted hammer forms near a significant level of support or coincides with a bullish divergence in a momentum indicator, the likelihood of a successful reversal may be higher. In implementing this strategy, risk management remains paramount. Setting stop-loss orders just below the inverted hammer's low can help protect against false signals or any continuation of the downtrend. In summary, the inverted hammer at the bottom of a downtrend serves as a beacon for potential upward market movement, encouraging investors to attentively watch for confirmatory signals. Integrating this pattern into broader analytical frameworks can sharpen investment strategies, potentially leading to well-timed entries in anticipation of market reversals. The inverted hammer at bottom pattern is a bullish reversal pattern that typically appears after a downtrend. It is identified by a small body at the lower end of the trading range with a long upper shadow and little to no lower shadow. This indicates that the trading session opened at a low, then prices were driven up, but closed near the opening price, suggesting the possibility of a market reversal as buyers begin to counteract the prevailing downward trend. Exploring variations of this pattern helps investors recognize similar patterns that occur under different market conditions. Variations might include differences in the color of the body, with a green or white body suggesting stronger buying pressure than a red or black body. Despite these variations, the key is the location of the pattern after a significant downtrend and the long upper shadow, which indicates that buyers were present and tried to push the prices up during the session. Understanding this pattern and its variations is crucial for making informed investment decisions. However, It is always recommended to look for additional confirmation before making a trade based on this pattern, as with any technical analysis tool, to improve the reliability of the signal.